Cryptocurrency risk and cryptocurrency risk management. The management of cryptocurrency risks. The Solomon Fadun, Risk Management of Everything channel, presents Cryptocurrency risk and cryptocurrency risk management. The management of cryptocurrency risks. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to notify you when we upload new videos. Thank you. This video discusses cryptocurrency risk and cryptocurrency risk management. It explains the management of cryptocurrency risks. In this video, you will understand the meaning of cryptocurrency, the evolution of cryptocurrency, types of cryptocurrency, characteristics of cryptocurrency, advantages and disadvantages of cryptocurrency, traditional currencies versus cryptocurrencies, how cryptocurrency works, top 15 cryptocurrencies, common risk management mistakes in crypto trading, risks associated with cryptocurrency transactions, the importance of risk management in cryptocurrency, cryptocurrency risks, cryptocurrency risk management process, critical components and strategies of cryptocurrency risk management, challenges in cryptocurrency risk management, and the role of risk management in improving crypto finance. Now, let us start. What is cryptocurrency? Cryptocurrency is a digital or virtual currency that uses cryptography for security and operates on decentralized networks, typically based on blockchain technology. A blockchain is a distributed ledger that records all transactions across a network of computers securely and transparently. Bitcoin, created in 2009 by an anonymous person or group using Satoshi Nakamoto's pseudonym, was the first cryptocurrency and remains the most well-known and widely used. Other notable cryptocurrencies include Ethereum, Ripple, XRP, Litecoin, and many more. Cryptocurrencies have gained attention for their potential to revolutionize finance, but they also face challenges, including regulatory scrutiny and concerns about security and adoption. Here are some key features and concepts associated with cryptocurrencies. 1. Decentralization. Unlike traditional currencies governments and central banks issued, cryptocurrencies operate on decentralized networks. This means no single entity controls the entire system, reducing the risk of manipulation or fraud. 2. Blockchain technology. Cryptocurrencies rely on blockchain, a distributed ledger that records all transactions across a network of computers. Each block in the chain contains a list of transactions, and once a block is completed, it is linked to the previous block, forming a chain of blocks. 3. Cryptography. Cryptocurrencies use cryptographic techniques to secure transactions and control the creation of new units. Public and private keys are used to facilitate secure transactions between parties. 4. Limited supply. Many cryptocurrencies have a fixed or predetermined issuance schedule. For instance, Bitcoin has a maximum supply of 21 million coins, designed to control inflation and mimic the scarcity of precious metals like gold. 5. Peer-to-peer transactions. Cryptocurrencies enable direct user transactions without intermediaries like banks. This can lead to faster and more cost-effective transactions, especially cross-border payments. 6. Anonymity and transparency. While transactions are recorded on the blockchain and transparent, the parties' identities are often pseudonymous. Users are identified by cryptographic addresses rather than personal information. However, the level of anonymity can vary among different cryptocurrencies. 7. Volatility. Cryptocurrency prices can be highly volatile, with values subject to rapid and significant fluctuations. Market demand, regulatory developments, technological advancements, and macroeconomic trends can influence cryptocurrency volatility. 8. Altcoins. Besides Bitcoin, There are thousands of alternative cryptocurrencies, commonly called altcoins. Some of these aim to improve upon the features of Bitcoin, while others serve different purposes, such as smart contracts, privacy, or specific industry applications. The evolution of cryptocurrency. The evolution of cryptocurrency can be seen as a journey from a radical idea to a mainstream, though still volatile, asset class. The evolution of cryptocurrency can be traced through several key phases, each marked by technological developments, regulatory changes, and shifts in public perception. Here is an overview of the significant stages in the evolution of cryptocurrency. 1. Pre-Bitcoin era, pre-2009. Cryptographic concepts. Digital currencies and cryptographic concepts existed before Bitcoin. Various attempts were made to create digital currencies, but they have yet to be widely adopted. 2. Bitcoin emergence, 2009 to 2012. Bitcoin white paper. In 2008, an individual or group using the pseudonym Satoshi Nakamoto published the Bitcoin white paper, outlining a decentralized digital currency. Bitcoin network launch. Bitcoin was officially launched in 2009 by mining the first block, the Genesis block or Block 0. Mining and decentralization. Bitcoin introduced the concept of blockchain and proof-of-work consensus, enabling decentralized and trustless transactions. Early adoption. Bitcoin gained attention among cryptography enthusiasts and those seeking an alternative to traditional fiat currencies. 3. Altcoins and blockchain diversification, 2011 to 2013. The emergence of altcoins, alternative cryptocurrencies, or altcoins, began to emerge, offering variations in mining algorithms, transaction speed, and features. Blockchain forks. The concept of blockchain forking became apparent, creating new cryptocurrencies by modifying existing blockchain code. 4. Rise of cryptocurrency exchanges, 2011 to 2013. First cryptocurrency exchanges, Bitcoin exchanges like Mt. Gox, 2010, and others started facilitating the trading of cryptocurrencies for fiat currencies, contributing to increased liquidity and market access. 5. Era of initial coin offerings, ICOs 2013 to 2017. ICO boom. The ICO model gained popularity as a fundraising method, allowing projects to raise capital by issuing tokens. With its smart contract functionality, Ethereum played a significant role in enabling ICOs. Ethereum and smart contracts. Ethereum, launched in 2015, introduced the ability to create decentralized applications, dApps, and smart contracts, expanding the use cases of blockchain technology beyond simple transactions. 6. Institutional interest and regulatory developments, 2017 to 2018. Bitcoin futures. Institutional interest in cryptocurrencies grew with the launch of Bitcoin futures contracts on traditional financial exchanges like CME and CBOE in late 2017. Regulatory scrutiny. Governments and regulatory bodies worldwide began looking more closely at cryptocurrency activities, leading to increased scrutiny and regulatory developments. 7. Bear market and maturation, 2018 to 2019. Market correction. The cryptocurrency market experienced a significant correction in 2018 after the speculative surge in 2017. Prices of many cryptocurrencies dropped, leading to a more cautious market sentiment. Focus on fundamentals. The industry shifted from speculative trading to developing fundamental infrastructure, including improved security, scalability, and usability. 8. DeFi, Decentralized Finance, and NFTs, 2020-present. DeFi explosion. The rise of decentralized finance, DeFi, platforms on blockchain networks like Ethereum allowed users to engage in various financial services without traditional intermediaries. NFT craze. Non-fungible tokens, NFTs, gained prominence, representing unique digital assets and creating new opportunities for artists, creators, and collectors. 9. Institutional adoption and mainstream recognition, 2020-present. Institutional investments. Major institutional players, including publicly traded companies and investment funds, began allocating significant capital to Bitcoin and other cryptocurrencies. Central bank digital currencies, CBDCs. Several central banks explored or initiated projects to develop their digital currencies, reflecting a growing acknowledgement of the importance of digital assets. 10. Ongoing technological developments and challenges, 2022-present. Layer 2 solutions. Continued efforts to address scalability issues and high transaction fees by developing and adopting Layer 2 solutions like Lightning Network and optimistic rollups. Sustainability concerns. Increased focus on addressing environmental concerns associated with the energy consumption of specific proof-of-work blockchain networks. The evolution of cryptocurrency is a dynamic and ongoing process shaped by technological innovations, market dynamics, regulatory developments, and broader societal trends. As the space matures, it will likely undergo further transformations and integrations with traditional financial systems. Types of cryptocurrency. Thousands of cryptocurrencies exist, with new ones being created regularly. Cryptocurrencies can be broadly categorized into several types based on their underlying technology, use cases, and functionalities. Here are the basic types of cryptocurrency. 1. Payment cryptocurrencies. These digital currencies are designed primarily for online and offline payments. Bitcoin, BTC, and Litecoin, LTC, are the most well-known examples. They aim to be a faster, cheaper, and borderless alternative to traditional money transfer systems. 2. Utility tokens. These tokens access specific features or functionalities within a blockchain project or platform. For instance, Ethereum, ETH, is the native token of the Ethereum network, used to pay for transaction fees and interact with decentralized applications, dApps, built on Ethereum. 3. Security tokens, enables creating and managing security tokens, representing ownership of real-world assets like real estate or company shares. These represent ownership or investment in a real-world asset, such as stocks, bonds, or even real estate, which is tokenized on a blockchain, for example Polymath, POLY. Security tokens can offer increased liquidity and fractional ownership compared to traditional asset classes. 4. Stablecoins, designed to minimize price volatility by pegging their value to traditional fiat currencies like the US dollar, including Tether, USDT, USD Coin, USDC, and DAI. These cryptocurrencies are designed to have a stable price, often pegged to the value of a fiat currency like the US dollar, USDT, or a basket of assets. This reduces the volatility of other cryptocurrencies and makes them more suitable for everyday transactions. 5. Central bank digital currencies, CBDCs. Several countries are exploring or developing their digital currencies issued by central banks. Central banks issue and control these digital versions of traditional fiat currencies. CBDCs are still under development in many countries, and their exact characteristics and functionalities may vary. They offer potential benefits like faster transactions and improved financial inclusion but raise concerns about central bank control over digital money. Beyond these main categories, there are also 1. Privacy coins, focus on anonymizing transactions on the blockchain, for example, Monero. 2. Governance tokens, allow holders to participate in voting decisions within a blockchain project. 3. Non-fungible tokens, NFTs, represent unique digital assets like artwork or collectibles. This is a partial list, and new types of cryptocurrencies with innovative functionalities are constantly emerging. It is crucial to research any cryptocurrency project before investing or using it. It is essential to note that the cryptocurrency space is dynamic, and new projects may emerge while existing ones evolve or fade away. Additionally, the regulatory landscape is subject to change, impacting the development and adoption of different types of cryptocurrencies. Always conduct thorough research and exercise caution when considering investments in cryptocurrencies. Advantages and disadvantages of cryptocurrency. Cryptocurrency offers a unique blend of potential benefits and drawbacks compared to traditional financial systems. It is important to note that the cryptocurrency landscape is dynamic, and factors such as regulatory developments and technological advancements can influence the balance of these pros and cons. Let us highlight the advantages and disadvantages of cryptocurrency. Advantages of cryptocurrency. 1. Decentralization. Cryptocurrencies operate on decentralized blockchain technology, reducing the influence of central authorities like governments or banks. This can enhance financial inclusivity and lessen the risk of centralized control. 2. Security. Cryptocurrencies use cryptographic techniques to secure transactions, providing high security. Blockchain's immutability makes it difficult for unauthorized parties to alter transaction data. 3. Financial inclusion. Cryptocurrencies can provide financial services to unbanked or underbanked populations who lack access to traditional banking infrastructure. Anyone with an internet connection can participate in cryptocurrency transactions. 4. Accessibility and inclusion. Cryptocurrencies enable borderless and permissionless transactions, allowing users to send and receive funds globally without intermediaries or the need for traditional banking infrastructure. 5. 24/7 market. Cryptocurrency markets operate 24/7, providing continuous access to trading and investment activities without the limitations of traditional market hours. 6. Ownership and control. Cryptocurrency users have greater control and ownership of their funds than traditional financial systems. Private keys provide access to funds, and users can manage their assets independently. 7. Reduced transaction costs. Cryptocurrency transactions can have lower fees than traditional financial systems, especially for international transfers, potentially reducing the overall cost of financial transactions. 8. Faster and cheaper transactions. Cryptocurrency transactions can be faster and cheaper than traditional transfers, especially for international payments. This is because they bypass intermediaries and rely on the efficiency of blockchain technology. 9. Inflation hedge. Some cryptocurrencies, like Bitcoin, have a limited supply programmed into their code. This can make them attractive as a hedge against inflation, as traditional currencies can lose value over time due to inflation. 10. Borderless transactions. Cryptocurrency can be sent and received anywhere in the world with an internet connection, eliminating geographical limitations associated with traditional currencies. Disadvantages of cryptocurrency. 1. Price volatility. Cryptocurrencies are known for their price volatility. Sudden and significant price fluctuations can pose challenges for investors and make it difficult to accurately predict the value of holdings. 2. Liquidity risk. While popular cryptocurrencies like Bitcoin have high trading volume, many lesser-known coins may have low liquidity. This can make buying or selling holdings quickly tricky, especially during periods of low market activity. 3. Regulatory uncertainty. The absence of consistent global regulations can lead to uncertainties and challenges, including potential fraud, scams, and inadequate investor protection. The regulatory landscape surrounding cryptocurrency is still evolving. Regulation changes could impact the value and use of cryptocurrencies, creating uncertainty for investors. 4. Security risks. Cryptocurrency wallets and exchanges can be vulnerable to hacking and theft. Choosing secure storage solutions and reputable platforms is crucial to protect investments. While blockchain technology is safe, the surrounding infrastructure, such as exchanges and wallets, may be susceptible to hacking, fraud, and cyber attacks, leading to the loss of funds. 5. Irreversibility of transactions. Once a cryptocurrency transaction is confirmed on the blockchain, it is irreversible. This lack of chargeback mechanisms can be a disadvantage in fraud or errors. 6. Limited acceptance. Despite growing acceptance, cryptocurrencies are only sometimes recognized as legal tender. More than limited acceptance in mainstream commerce can restrict their use for everyday transactions. 7. Environmental impact. Mining some cryptocurrencies, particularly those that use a proof-of-work consensus mechanism, can require significant energy, raising environmental concerns. 8. Scalability challenges. Some blockchain networks face scalability issues, leading to slow transaction processing times and higher fees during periods of high demand. 9. Perceived association with illicit activities. Cryptocurrencies have been associated with illegal activities due to their pseudonymous nature, raising concerns about their potential use in money laundering, tax evasion, and other illicit transactions. 10. Lack of consumer protections. Cryptocurrency transactions may need more consumer protections from traditional financial systems, making recovering lost or stolen funds more challenging. As the cryptocurrency ecosystem evolves, investors should address disadvantages through technological advancements, regulatory developments, and increased industry maturity. Individuals and entities must consider these factors carefully when engaging with cryptocurrencies and stay informed about the evolving landscape. Characteristics of cryptocurrency. Cryptocurrencies possess several distinct characteristics that set them apart from traditional currencies. These features contribute to the unique nature and functionality of digital currencies. Here are some key characteristics of cryptocurrencies. 1. Decentralization. Cryptocurrencies operate on decentralized computer networks, often utilizing blockchain technology. This means no central authority or government controls the entire system, reducing the risk of manipulation or censorship. 2. Blockchain technology. Most cryptocurrencies use blockchain, a distributed ledger that records all transactions across a network of computers. Each block in the chain contains a list of transactions, and once a block is completed, it is linked to the previous one, forming a secure and transparent chain. 3. Cryptography. Cryptocurrencies rely on cryptographic techniques to secure transactions and control the creation of new units. Public and private keys are used to facilitate secure transactions between parties, ensuring the integrity and security of the network. 4. Limited supply. Many cryptocurrencies have a fixed or predetermined issuance schedule. For example, Bitcoin has a maximum supply of coins, introducing scarcity into the system like precious metals like gold. 5. Anonymity and pseudonymity. While transactions on the blockchain are transparent and can be traced, the parties' identities are often pseudonymous. Users are identified by cryptographic addresses rather than personal information, providing a degree of privacy. 6. Peer-to-peer transactions. Cryptocurrencies enable direct user transactions without intermediaries like banks. This can lead to faster and more cost-effective transactions, especially cross-border payments. 7. Global accessibility. Cryptocurrencies are accessible to anyone with an internet connection, breaking down geographical barriers. Users can send and receive digital currencies without the need for traditional banking systems, promoting financial inclusion. 8. Irreversibility of transactions. Once a transaction is added to the blockchain, it is typically irreversible. This immutability ensures the integrity of the transaction history but also means that users must exercise caution to avoid errors. 9. Volatility. Cryptocurrency prices are known for their volatility. Values can experience rapid and significant fluctuations influenced by market demand, regulatory developments, and macroeconomic trends. 10. Smart contracts. In some cryptocurrencies, certain cryptocurrencies, such as Ethereum, support smart contracts. These are self-executing contracts with coded terms and conditions. Smart contracts automatically execute and enforce the terms when predefined conditions are met. 11. Innovation and experimentation. The cryptocurrency space is characterized by continuous innovation. New projects and technologies are regularly introduced, and experimentation is encouraged. This dynamic environment fosters the development of diverse use cases and applications. 12. Community-driven development. Many cryptocurrency projects are open source and rely on community contributions for development and improvement. This decentralized approach allows for a broad range of perspectives and expertise to shape the evolution of the technology. 13. Immutability. Once a transaction is added to the blockchain, it becomes a permanent part of the record. The decentralized and distributed nature of the blockchain ensures that the transaction history cannot be altered retroactively. Immutability enhances the security and trustworthiness of transactions, as it prevents unauthorized modifications. 14. Consensus mechanisms. Cryptocurrencies rely on consensus mechanisms to agree on the blockchain state. Common mechanisms include proof of work, POW, proof of stake, POS, and variations like delegated proof of stake, TPOS, and practical Byzantine fault tolerance, PBFT. Consensus mechanisms ensure that participants in the network agree on the validity of transactions, adding a layer of trust and security to the decentralized system. 15. Open source. Many cryptocurrency projects are open source, meaning that the source code is publicly accessible and can be viewed, modified, and distributed by anyone. Open source development encourages transparency, collaboration, and innovation. It allows developers worldwide to contribute to the improvement and security of the code base. 16. Inherent value. The value of cryptocurrencies is often driven by scarcity, utility, and market demand. Some, like Bitcoin, are designed to mimic the scarcity and value proposition of precious metals like gold. Understanding the factors contributing to the perceived value of a cryptocurrency can help investors make informed decisions. 17. Permissionless transactions. Cryptocurrencies allow users to participate without permission from intermediaries like banks. Anyone with an internet connection can create a wallet and transact in digital currencies. Permissionless access promotes financial inclusivity, enabling individuals who may be excluded from traditional banking systems to participate in the global economy. 18. Programmability. Smart contracts. Some cryptocurrencies, like Ethereum, support programmable contracts known as smart contracts. These self-executing contracts automatically enforce predefined rules and conditions when specific triggers are met. Smart contracts expand the functionality of cryptocurrencies beyond simple transactions, enabling the creation of decentralized applications, dApps, and automated, trustless agreements. 19. Finality of settlement. Cryptocurrency transactions are final once confirmed and added to the blockchain. Unlike traditional payment systems where chargebacks are possible, cryptocurrencies do not have a central authority to reverse transactions. The settlement finality reduces fraud and gives users more control over their funds. 20. Limited intermediaries. Cryptocurrencies facilitate peer-to-peer transactions, minimizing the need for intermediaries like banks. This can lead to faster and potentially more cost-effective transactions, especially cross-border transfers. Reduced reliance on intermediaries aligns with the ethos of decentralization, offering users greater control over their financial transactions. 21. Privacy features. While transactions on the blockchain are transparent, some cryptocurrencies incorporate privacy features to enhance user confidentiality. Privacy features address concerns related to the traceability of transactions, allowing users to have a degree of anonymity in their financial activities. 22. Tokenization. Cryptocurrencies enable the creation of tokens representing assets, ownership, or specific rights on a blockchain. These tokens can represent real-world assets like real estate or company shares. Tokenization adds versatility to blockchain networks, enabling the secure and decentralized representation and transfer of a wide range of assets. Understanding these characteristics provides a comprehensive view of how cryptocurrencies function and their potential impact on various aspects of the financial landscape. It is important to note that the cryptocurrency space is dynamic, and new developments and features continue to emerge. Traditional currencies versus cryptocurrencies. Traditional currency is the kind of money most people are familiar with. They are physical bills and coins printed by governments or central banks. Because a central authority controls them, they are generally stable and widely accepted. Cryptocurrencies, on the other hand, are a new type of digital asset. They exist only electronically on a decentralized network of computers called a blockchain. No single entity controls them, and their values can fluctuate rapidly. Cryptocurrencies are yet to be accepted widely as traditional currencies, but some businesses accept them as payment. It is essential to compare traditional currencies and cryptocurrencies. Here are the critical differences between the two currencies. 1. Centralization. Traditional currencies are centralized control by governments and central banks. Cryptocurrencies are decentralized, with no single authority or government controlling the currency. 2. Form. Traditional currencies exist in physical, cash, and digital, bank balances, forms. Cryptocurrencies exist only in digital form, with no physical representation. 3. Issuance and supply. Central authorities can issue more traditional currency, and central banks manage the money supply. Many cryptocurrencies have a fixed supply or a capped maximum governed by code. For example, Bitcoin has a maximum supply of coins. 4. Verification and transactions. Traditional currency transactions are verified by banks and financial institutions, often involving intermediaries. Cryptocurrency transactions are verified by a decentralized network of nodes using cryptographic algorithms. Peer-to-peer transactions are possible without intermediaries. 5. Anonymity. Traditional currencies limited anonymity because financial institutions often require identification for transactions. Cryptocurrencies constitute pseudonymous transactions, providing varying degrees of privacy. 6. Accessibility. Generally, traditional currencies are confined by national borders, requiring currency conversion for international transactions. Cryptocurrencies' global accessibility allows for borderless transactions without currency conversion. 7. Speed and cost of transactions. Traditional currency transactions may take time, especially for cross-border transfers, and may involve fees. Cryptocurrency transactions can be faster and potentially cheaper, especially for international transfers, but transaction costs can vary. 8. Volatility. Generally, traditional currencies are stable compared to cryptocurrencies. Cryptocurrencies are known for price volatility, with values subject to rapid and significant fluctuations. 9. Regulation. Governments and central banks heavily regulate traditional currencies. Cryptocurrencies are subject to varying degrees of regulation globally, with some countries embracing them while others impose restrictions. 10. Purpose and use cases. Traditional currencies are widely accepted for all types of online and offline transactions. Cryptocurrencies are initially designed as digital currency alternatives but are also used for various applications, including smart contracts, decentralized finance, DeFi, and tokenization. In summary, while traditional currencies have a long-established history and are deeply integrated into the global financial system, cryptocurrencies offer a decentralized digital alternative with features like increased privacy, global accessibility, and potential cost efficiencies. However, they also face challenges such as regulatory uncertainty and price volatility. The coexistence of these two forms of currency continues to shape the evolving landscape of global finance. How cryptocurrency works. Cryptocurrency relies on two key concepts: blockchain technology and cryptography. Cryptocurrencies operate on the principles of blockchain technology and use cryptographic techniques to secure transactions. Here is an overview of how cryptocurrency works. 1. Blockchain technology. Decentralized ledger. Cryptocurrencies utilize a decentralized ledger called a blockchain. This ledger is maintained by a network of computers, nodes, that validate and record transactions chronologically. Blocks and chain. Transactions are grouped into blocks linked to the previous one, forming a chain. This ensures the integrity of the transaction history. 2. Cryptographic security. Public and private keys. Participants in a cryptocurrency network have a pair of cryptographic keys, a public key, known to others, and a private key, kept secret. The combination of these keys ensures the security and authenticity of transactions. Digital signatures. When a user initiates a transaction, their private key creates a digital signature, a mathematical proof of the transaction's authenticity. The signature is verified using the user's public key. 3. Consensus mechanisms. Proof of work, POW, and proof of stake, POS. Cryptocurrencies use consensus mechanisms to agree on the state of the blockchain. In POW, participants, miners, solve complex mathematical puzzles to add blocks to the chain. In POS, validators help create new blocks based on the amount of cryptocurrency they hold or other criteria. 4. Mining, for POW. Validation of transactions. In POW-based cryptocurrencies like Bitcoin, miners compete to solve complex mathematical problems. The first solution is the right to add a new block to the blockchain. Block reward. Successful miners are rewarded with newly created cryptocurrency, block reward, and transaction fees for their efforts. 5. Issuance and supply. Limited supply. Many cryptocurrencies have a capped maximum supply, introducing scarcity. For example, Bitcoin has a maximum supply of coins. Mining or staking. New coins are circulated through mining, POW, or staking, POS, processes. 6. Decentralization. No central authority. Cryptocurrencies operate without a central authority or intermediary. The decentralized nature of the network reduces the risk of single points of failure and central control. 7. Transaction verification. Node consensus. Nodes on the network reach a consensus on the validity of transactions. A transaction is confirmed when it is added to the blockchain by most nodes. 8. Pseudonymity and privacy. Addresses. Users are identified by cryptographic addresses rather than personal information, providing a level of pseudonymity. Privacy features. Some cryptocurrencies incorporate privacy-focused features to enhance user transaction confidentiality. 9. Smart contracts. In some cryptocurrencies, self-executing contracts. Smart contracts are self-executing contracts with coded terms and conditions. They automatically execute and enforce the terms when predefined conditions are met. 10. Network security. Cryptography and decentralization. The combination of cryptographic techniques, decentralization, and consensus mechanisms contributes to the security and resilience of the network against attacks. However, it is essential to emphasize that there are various cryptocurrencies, each with unique features and consensus mechanisms. The details provided here offer a general overview, and the specific workings may vary among different cryptocurrencies. Top 15 cryptocurrencies. There are several types of cryptocurrencies, but the ranking of cryptocurrencies changes based on market dynamics and developments. It is essential to check the latest information from reliable sources for the most up-to-date rankings. Here are some of the top cryptocurrencies. 1. Bitcoin, BTC. Bitcoin is the first and most well-known cryptocurrency, created by an unknown person or group using Satoshi Nakamoto's pseudonym in 2009. It is often called digital gold due to its limited supply, 21 million coins, and its focus on being a decentralized store of value. 2. Ethereum, ETH. Ethereum is a decentralized platform that enables the creation of smart contracts and decentralized applications, dApps. Ether, ETH, is the native cryptocurrency used for transactions and computational services on the Ethereum network. 3. Binance Coin, BNB, created as a utility token for the Binance Exchange, BNB has expanded its use cases. It is used for various purposes, including transaction fees on the Binance platform, participating in token sales on Binance Launchpad, and more. 4. Tether, USDT. Tether is a stable coin pegged to the value of the US dollar. It provides stability in value, making it a popular choice for traders to move funds quickly between different cryptocurrencies without exposure to volatility. 5. Cardano, ADA. Cardano is a blockchain platform focusing on security and scalability. It aims to provide a more sustainable and balanced ecosystem for decentralized applications and smart contracts. 6. Ripple, XRP. Ripple is designed for fast and cost-efficient cross-border transactions. Financial institutions use XRP to facilitate international money transfers with reduced fees and settlement times. 7. Solana, SOL. Solana is a high-performance blockchain platform with fast transaction speeds and low fees. It aims to provide a scalable and decentralized infrastructure for decentralized applications and crypto projects. 8. Polkadot, DOT. Polkadot is a multi-chain platform that enables different blockchains to interoperate and share information. It focuses on creating a more connected and scalable web where different blockchains can communicate. 9. Dogecoin, DOG. Dogecoin started as a meme cryptocurrency based on the Doge internet meme. It gained popularity for its active community and is often used for tipping and charitable donations. 10. USD Coin, USDC. USD Coin is a stable coin pegged to the US dollar. It provides a stable value and is commonly used for various financial transactions and trading pairs. 11. Avalanche, AVAX. Avalanche is a blockchain platform that aims to provide a highly scalable and customizable infrastructure for decentralized applications. It uses a consensus mechanism called Avalanche to achieve fast and secure transactions. 12. Chainlink, LINK. Chainlink is a decentralized Oracle network that connects smart contracts with real-world data. It enhances the capabilities of intelligent contract applications by providing access to external information in a secure and decentralized manner. 13. Litecoin, LTC. Created by Charlie Lee in 2011, Litecoin is often referred to as the silver to Bitcoin's gold. It shares many similarities with Bitcoin but offers faster transaction confirmation times and a different hashing algorithm. 14. Bitcoin Cash, BCH. Bitcoin Cash is a fork of Bitcoin that emerged in 2017. It aims to address scalability issues by increasing the block size, allowing more transactions to be processed in each block. 15. Stellar, XLM. Stellar is a fast and low-cost cross-border payment platform. It focuses on financial inclusion, facilitating transactions between different currencies and making financial services more accessible globally. The cryptocurrency market is dynamic, and the status of these cryptocurrencies may change over time based on market trends, technological developments, and regulatory changes. Always conduct thorough research and stay informed when considering investments in the cryptocurrency space. Common risk management mistakes in crypto trading. Learning from past mistakes is an excellent but costly approach to success. Crypto trading, like any other type, is based on clear ideas and strategies that all crypto traders, particularly newcomers, must comply with. Here are some common mistakes that crypto traders make that should be avoided. 1. Trading without a strategy and goal. Trading without a clear plan can lead to losses. When developing a strategy, a trader must consider its profit goals, risk tolerance, and investment timeline. 2. Short-term planning. The cryptocurrency market is highly volatile. It is often more beneficial to consider long-term investments. 3. Excessive diversification. Over-diversification can lead to holding many underperforming assets. Diversify only when a trader understands the fundamental principles of different types of investments. 4. Using a non-reputed cryptocurrency exchange. New traders should choose a dependable, trustworthy, and secure exchange. The components of trust and security are often overlooked. 5. Lack of fundamental and technical analysis knowledge. Trading without understanding market fundamentals can lead to losses. A trader must learn the market's fundamental and technical analysis before trading. 6. Investing money you can't afford to lose. Cryptocurrency is highly volatile, and the risk of massive losses accompanies incredible profits. Be aware of the risks involved and plan for the worst-case scenario. Risks associated with cryptocurrency transactions. Investing in cryptocurrency carries a unique set of risks compared to traditional investments. Investing in cryptocurrencies can be potentially rewarding but also has inherent risks. Investors must know these risks and implement a sound risk management process to mitigate potential losses. As it is often said, risk is everywhere. Every activity contains an inherent risk, and cryptocurrency transactions are not an exemption from risk. Here are some key risk factors influencing investment in cryptocurrency. 1. Volatility. Volatility is one of the most basic indicators of assets' financial health, and cryptocurrency is one of the most volatile investment options. Speculation fuels the cryptocurrency market, with some investors quickly buying and selling their holdings as soon as there is a sign of the price drop. Cryptocurrency prices are highly volatile, influenced by market sentiment, regulatory developments, macroeconomic trends, and technological advancements. The rapid price fluctuations can result in substantial gains, but they also pose the risk of significant losses. Traders and investors should be prepared for price swings and avoid making impulsive decisions based on short-term market movements. Wild speculation over cryptocurrency further sends prices soaring up and down. 2. Regulatory risks. The regulatory environment for cryptocurrencies is still evolving, with different countries taking varied approaches. Regulation changes can impact the legality, acceptance, and usage of cryptocurrencies. Regulatory uncertainty can lead to market instability. Investors should stay informed about the regulatory landscape in their jurisdictions and be prepared to adapt their strategies based on regulatory developments. 3. No legal protection. Credit and debit cards have legal protection. If something goes wrong, for example, a dispute in a purchase made through a card, the bank has a process to help recover the money. Typical cryptocurrencies do not have such protection. 4. Information about transactions is made public. People think cryptocurrency transactions are anonymous, but the truth is complex. Cryptocurrency transactions are typically recorded on a public ledger called a blockchain, a public list of every cryptocurrency transaction, payments and receipts. Some blockchains may include details like amount, sender, recipient, and wallet address. It is possible to use this information to identify the person involved in a specific transaction. Likewise, when a person buys something from a seller, he can collect other information, including the shipping address. This can be used to identify the buyer. 5. Cryptocurrency payments are not reversible. Once payment is made with cryptocurrency, the buyer can only get a refund if the item was returned. Hence, it is necessary to know the seller's reputation before buying something with cryptocurrency. This is because cryptocurrencies are decentralized. 6. Loss or destruction of the private key. Cryptocurrencies are stored in a digital wallet and controlled only by the possessor of the public key and the private key relating to the digital wallet in which the cryptocurrency is held, both unique. If the private key is compromised, lost or destroyed, an investor may be unable to access the cryptocurrency held in the related digital wallet, which will eventually be lost. If the third party acquires the private key, then the third party may gain access to the cryptocurrency. 7. Cyber theft and hackers. Cryptocurrencies are held in a digital wallet and are traded through digital currency exchanges. Because of its online dependence and anonymity, it appeals to cybercriminals to gain access to cryptocurrency wallets and trade platforms, which criminals use through various phishing attacks. 8. Risk associated with peer-to-peer transaction. This cryptocurrency marketplace connects buyers and sellers directly, and any cryptocurrency transactions are paid directly between the buyers and the sellers. As simple as it is, mistakes or negligence can cause a crypto trader to lose its assets. However, there is a risk of refusing scammers or fraudulent schemes, such as buyers refusing to pay for the cryptocurrencies received or sellers refusing to release the token or key. 9. Exchange rate risk. Investing in most cryptocurrencies might require a party to enter into contracts to pay with a foreign currency, for example, the dollar. The buyers and sellers of cryptocurrency have their exchange rate, which differs from that of the black market or bank's official rate. 10. Security concerns. Cryptocurrency exchanges, wallets, and blockchain networks can be vulnerable to hacking, phishing attacks, and security breaches. Investors should prioritize the security of their holdings by using reputable wallets, enabling two-factor authentication, and adopting best practices for securing private keys. Storing a significant portion of funds in hardware wallets offline can add an extra layer of protection. 11. Market liquidity. Liquidity refers to the ease with which an asset can be bought or sold without affecting its price. Some cryptocurrencies may have lower liquidity, leading to potential slippage and challenges in executing trades. Illiquid investments can be challenging to exit quickly, and investors may need help selling significant positions without significantly impacting the market. Traders should exercise caution when dealing with less liquid assets. 12. Technology risks. Cryptocurrencies rely on blockchain technology, and underlying code or protocol vulnerabilities can pose risks. This includes the potential for bugs, security flaws, or issues related to network upgrades. Investors should stay informed about the technological aspects of the cryptocurrencies they hold. Conducting due diligence on the development team, reviewing the project's codebase, and monitoring updates and improvements are essential to understanding and managing technology risks. 13. Operational risks. Issues such as exchange outages, technical glitches, or errors in executing trades can disrupt the smooth functioning of the market. Users should choose reputable exchanges with a track record of reliability. Testing the platform with small transactions before committing significant funds can help identify potential operational risks. 14. Fraud and scams. The cryptocurrency space is susceptible to various fraudulent schemes, Ponzi schemes, and scams, often targeting inexperienced or unsuspecting investors. Investors should exercise caution, be wary of unsolicited investment opportunities, and conduct thorough research before participating in any project or investment. 15. Adoption and technology risks. The success of cryptocurrencies often depends on widespread adoption and technological advancements. Failure to achieve mass adoption or technological setbacks can impact the value and utility of a cryptocurrency. Investors should stay informed about the development roadmap of the cryptocurrencies they hold, monitor industry trends, and assess the potential for mainstream adoption. Technological upgrades, partnerships, and community engagement can influence a project's long-term viability. These risk factors highlight the multifaceted nature of investing in cryptocurrencies. Developing a comprehensive understanding of these risks and implementing effective risk management strategies are essential for navigating the dynamic and evolving landscape of the cryptocurrency market. The importance of risk management in cryptocurrency. Risk management is crucial in cryptocurrency due to the unique characteristics and challenges of digital assets. Here are key reasons why risk management is essential in the realm of cryptocurrencies. 1. Volatility mitigation. Cryptocurrencies are known for their high price volatility. Implementing risk management strategies helps mitigate the impact of sudden and significant price fluctuations. By setting realistic profit and loss targets, diversifying portfolios, and using risk management tools, investors can reduce exposure to extreme market volatility. 2. Preservation of capital. Cryptocurrency investments come with the risk of potential losses. Sound risk management aims to preserve capital and avoid substantial financial setbacks. Protecting capital ensures investors have the financial resources to participate in future investment opportunities rather than facing significant portfolio erosion. 3. Regulatory compliance. Regulatory environments for cryptocurrencies are evolving, and non-compliance can lead to legal issues. Risk management includes staying informed about regulatory developments and adapting strategies accordingly. Complying with regulations helps avoid legal consequences, regulatory scrutiny, and potential disruptions to cryptocurrency-related activities. 4. Security enhancement. Cryptocurrencies are vulnerable to security threats, including hacking, phishing, and fraud. Effective risk management involves securing private keys, using reputable wallets and exchanges, and implementing security best practices. Enhancing security measures protects users from financial losses, unauthorized access, and potential breaches, fostering trust in the cryptocurrency ecosystem. 5. Reducing counterparty risks. Engaging with third-party services, such as exchanges and wallet providers, introduces counterparty risks. Risk management includes assessing the reliability and security measures of these services. Reducing reliance on vulnerable or untrustworthy counterparties minimizes the risk of fraud, insolvency, and mismanagement. 6. Operational stability. Cryptocurrency exchanges and platforms can experience operational issues, disrupting trading or fund access. Risk management involves choosing reputable platforms and testing smaller transactions. Ensuring operational stability minimizes the risk of platform outages, technical glitches, or errors that could impact the execution of trades. 7. Strategic decision-making. Risk management facilitates informed and strategic decision-making. This includes assessing market conditions, evaluating potential investments, and adjusting positions based on changing circumstances. Strategic decision-making guided by risk management principles helps investors navigate the dynamic cryptocurrency market and respond to evolving trends and opportunities. 8. Adaptation to market conditions. Cryptocurrency markets can be influenced by various factors, including macroeconomic trends, technological developments, and regulatory changes. Risk management involves adapting strategies to changing market conditions. Being agile and responsive to market dynamics allows investors to capitalize on opportunities and adjust their risk exposure in alignment with prevailing conditions. 9. Prevention of emotional decision-making. The cryptocurrency market's volatility can evoke emotional responses, leading to impulsive decision-making. Risk management strategies, including setting predefined targets and using stop-loss orders, help prevent emotional reactions. Avoiding emotional decision-making enhances discipline, consistency, and adherence to a well-thought-out investment plan, improving overall portfolio performance. 10. Contingency planning. Risk management includes contingency planning for unexpected events, such as technical issues, market crashes, or regulatory changes. Establishing emergency plans ensures preparedness for unforeseen circumstances. Contingency planning minimizes the impact of unexpected events, allowing users and investors to respond strategically rather than impulsively during crises. 11. Long-term sustainability. Implementing effective risk management practices contributes to the long-term sustainability of cryptocurrency investments. Consistent and prudent risk management helps protect capital and ensures ongoing participation in the market. A long-term investment strategy contributes to overall portfolio growth and resilience, even in short-term market fluctuations. 12. Enhanced investor confidence. Transparent and well-executed risk management practices enhance investor confidence. Investors are more likely to participate in cryptocurrency when they perceive a commitment to risk mitigation. Increased investor confidence fosters a healthier and more stable cryptocurrency ecosystem, attracting a broader range of participants and supporting market growth. 13. Reduction of black swan events. Cryptocurrency markets can be susceptible to unexpected and extreme events, often called black swan events. Effective risk management strategies aim to identify and mitigate the impact of such unforeseen occurrences. Reducing exposure to black swan events helps investors and traders better navigate turbulent market conditions and minimize potential catastrophic losses. 14. Psychological well-being. The inherent volatility of the cryptocurrency market can lead to stress and anxiety for investors. Risk management practices, including setting realistic goals and utilizing stop-loss orders, contribute to psychological well-being. A calm and rational mindset, fostered by effective risk management, allows investors to make decisions based on logic rather than emotions, ultimately improving mental health during market fluctuations. 15. Facilitation of long-term planning. Risk management supports the development and execution of long-term investment plans. This involves setting clear objectives, defining risk tolerance, and establishing a structured approach to portfolio management. Long-term planning enables investors to withstand short-term market volatility, capitalize on growth opportunities, and achieve financial goals without being swayed by temporary market fluctuations. 16. Enhanced due diligence. Risk management encourages thorough due diligence before engaging in cryptocurrency investments. This includes researching projects, understanding technology, assessing market conditions, and staying informed about regulatory developments. Enhanced due diligence helps investors make well-informed decisions, reducing the likelihood of falling victim to scams, fraud, or poor quality projects. 17. Protection against systematic risks. Systematic risks, such as global economic downturns or financial crises, can impact various asset classes, including cryptocurrencies. Risk management strategies consider the broader economic context and aim to protect portfolios from systematic risks. Protection against systematic risks ensures a more resilient portfolio that can withstand external shocks and financial uncertainties. 18. Strategic positioning for market opportunities. Effective risk management enables investors to capitalize on market opportunities strategically. This includes preparing to enter or exit positions based on evolving market conditions. Strategic positioning allows investors to exploit favorable trends, new projects, or emerging technologies while minimizing exposure to unfavorable market developments. 19. Compliance with risk appetite. Risk management involves aligning investment strategies with individual risk tolerance and overall risk appetite. Understanding personal risk preferences ensures investment decisions align with the investor's comfort level. Compliance with risk appetite helps avoid situations where investors may take on excessive risk, leading to stress, anxiety, and potential financial losses. 20. Continuous monitoring and adjustment. Risk management is an ongoing process that involves continuous monitoring of market conditions, project developments, and regulatory changes. Regular assessments allow for the adjustment of strategies to align with the evolving landscape. Constant monitoring ensures that risk management strategies remain relevant and practical, providing the flexibility to adapt to changing market dynamics. 21. Minimization of overtrading. Overtrading, or excessive buying and selling, can harm portfolio performance. Risk management strategies, such as setting trading limits and adhering to a disciplined approach, help minimize the risk of overtrading. Minimizing overtrading promotes a more measured and thoughtful approach to investment decisions, preventing impulsive actions driven by short-term market fluctuations. 22. Educational opportunities. Risk management encourages users to continually educate themselves about the cryptocurrency market, blockchain technology, and related concepts. This ongoing learning process enhances investors' abilities to make informed decisions. Education equips investors with the knowledge needed to navigate the complexities of the cryptocurrency space, identify potential risks, and seize growth opportunities. 23. Prevention of panic selling. During market downturns or heightened volatility, panic selling can lead to significant losses. Risk management strategies help prevent impulsive decisions, including stop-loss orders and clear exit plans. Preventing panic selling ensures investors remain disciplined and focused on their long-term investment objectives rather than reacting emotionally to short-term market movements. 24. Community and network building. Active participation in the cryptocurrency community and networks can provide valuable insights, collaborative opportunities, and support. Risk management involves building connections with other stakeholders and staying engaged in relevant discussions. Community and network building foster a sense of camaraderie, knowledge sharing, and collective problem solving, contributing to a more robust and informed investor community. 25. Preparation for market corrections. Cryptocurrency markets may experience corrections, where asset prices decline from their peak levels. Risk management prepares investors for market downturns, enabling them to navigate and capitalize on potential opportunities. Preparing for market corrections helps investors avoid panic, make informed decisions during downturns, and position themselves strategically for recovery. 26. Diversification and asset allocation. Risk management involves diversifying portfolios across different cryptocurrencies and asset classes, reducing exposure to the performance of a single asset. Asset allocation strategies aim to balance risk and return. Diversification and asset allocation enhance portfolio resilience and mitigate the impact of poor performance in any single asset, contributing to more stable and consistent returns. 27. Fulfillment of financial goals. Risk management is integral to achieving long-term financial goals. By aligning investment strategies with specific objectives, investors can make strategic decisions that support wealth accumulation, preservation, or other financial aspirations. Consequently, risk management is vital for individuals and entities involved in the cryptocurrency space. It safeguards against potential pitfalls and fosters a more resilient, secure, and sustainable environment for the broader adoption and development of digital assets. Cryptocurrency risks. Investing in or using cryptocurrencies comes with various risks, reflecting the unique characteristics of the digital asset space. It is essential for individuals to be aware of these risks and to exercise caution when participating in the cryptocurrency market. Here are some critical risks associated with cryptocurrencies. 1. Price volatility. Cryptocurrency prices are highly volatile, with values subject to rapid and unpredictable fluctuations. Market sentiment, regulatory developments, macroeconomic factors, and technological changes can all contribute to price volatility. Investors may experience significant gains but are also exposed to the risk of substantial losses if market conditions change abruptly. 2. Regulatory risks. Regulatory environments for cryptocurrencies are still evolving, and changes in regulations can impact the legality, acceptance, and use of digital assets. Different countries may adopt varying approaches, ranging from embracing to restricting cryptocurrencies. Regulatory uncertainty can lead to market instability, and regulation changes may affect the value and functionality of specific cryptocurrencies. 3. Security concerns. Cryptocurrency exchanges, wallets, and blockchain networks can be susceptible to hacking, phishing attacks, and security breaches. Users risk losing their funds if security measures are not adequately implemented. Security breaches can result in financial losses, erode trust in the ecosystem, and impact the credibility of specific projects. 4. Market liquidity. Some cryptocurrencies may have lower liquidity, challenging buying or selling large amounts without affecting the market price. Illiquid assets can lead to slippage, where the execution price differs from the expected price. Traders may need help executing trades at desired prices, and market manipulation becomes more feasible with less liquid assets. 5. Technology risks. Technological vulnerabilities, bugs, or flaws in the underlying blockchain code can pose risks. Network upgrades and forks can lead to temporary disruptions or create new, competing assets. Technical issues can impact the functionality and security of a cryptocurrency. Users may need help with network upgrades or changes to the protocol. 6. Operational risks. Cryptocurrency exchanges and platforms may experience outages, technical glitches, or errors in executing trades. These operational issues can disrupt the smooth functioning of the market. Users may face challenges accessing funds, executing trades, or navigating platform interfaces during operational disruptions. 7. Fraud and scams. The cryptocurrency space is susceptible to various fraudulent schemes, Ponzi schemes, and scams. These may involve fake initial coin offerings, ICOs, phishing attacks, or fraudulent projects promising high returns. Investors risk losing funds to fraudulent activities, and scams can damage the reputation of the broader cryptocurrency ecosystem. 8. Adoption and technology risks. The success of cryptocurrencies often depends on widespread adoption and technological advancements. Failure to achieve mass adoption, technological setbacks, or changes in user preferences can impact the value and utility of a cryptocurrency. Investors may face challenges if a project fails to gain traction and technological developments in the broader industry outpace a specific cryptocurrency. 9. Privacy concerns. While some cryptocurrencies offer privacy features, others may lack robust privacy measures. The transparency of blockchain transactions can raise privacy concerns, especially if users' identities are linked to their addresses. Users may face risks related to the traceability of their transactions, potentially compromising their financial privacy. 9. Geopolitical risks. Geopolitical events, such as regulatory changes, government crackdowns, or geopolitical tensions, can impact the cryptocurrency market. Cryptocurrencies may be subject to different regulatory approaches in various countries. Changes in the geopolitical landscape can lead to uncertainty, affecting market sentiment and the legal status of cryptocurrencies in specific regions. 10. Dependency on network effects. The value and success of specific cryptocurrencies are often influenced by network effects. The more users and businesses adopt a cryptocurrency, the more valuable and widely accepted it becomes. Newer or less established cryptocurrencies may need help gaining widespread adoption, limiting their potential utility and value. 11. Loss of private keys. Cryptocurrency users must manage private keys to access their funds. Losing or compromising private keys can result in the permanent loss of funds. Users need to safeguard their private keys securely. The irreversibility of transactions means that lost private keys cannot be recovered, leading to potential financial losses. 12. Tokenomics and economic risks. The economic models of specific cryptocurrencies may face challenges related to token supply, inflation, deflation, or economic governance. Users and investors should understand the financial principles behind specific cryptocurrencies to assess potential risks related to inflation, scarcity, and the project's long-term viability. 13. Environmental concerns. For proof-of-work cryptocurrencies, proof-of-work (POW) cryptocurrencies, such as Bitcoin, have faced criticism for their energy consumption and environmental impact. Environmental concerns may lead to regulatory scrutiny, public backlash, or a preference shift toward more environmentally friendly consensus mechanisms. 14. Human and operational errors. Users can make errors in handling cryptocurrencies, such as sending funds to the wrong address or incorrectly setting transaction fees. Additionally, development teams may introduce bugs or errors in code. Human and operational errors can lead to financial losses, disruptions, or vulnerabilities in the functionality of a cryptocurrency. 16. Smart contract vulnerabilities. Smart contracts, while powerful, are subject to vulnerabilities in their code. Bugs or flaws in the smart contract logic can lead to unintended consequences, including financial losses. Users should conduct thorough audits of smart contracts before interacting with them. Additionally, the immutability of blockchain can make correcting errors in smart contracts challenging. 17. Counterparty risks. Cryptocurrency transactions often involve counterparties, such as exchanges, wallet providers, or other users. Trusting third-party services introduces the risk of fraud, insolvency, or mismanagement. Users should carefully choose and regularly assess exchanges and other services' reputation and security measures. Cold storage and hardware wallets can reduce reliance on third-party services. 18. Lack of consumer protections. Unlike traditional financial systems, cryptocurrencies often need more consumer protection banks or financial regulators provide. There is no recourse for users who lose funds due to mistakes or malicious activities. Users should be responsible for securing their assets, using reputable services, and exercising caution to avoid pitfalls. 19. Technological obsolescence. Rapid technological advancements may lead to the obsolescence of specific cryptocurrencies or blockchain technologies. Newer, more efficient technologies could emerge, reducing the relevance of existing projects. Investors and users should stay informed about technological developments and consider the long-term viability of the projects they are involved in. 20. Social engineering attacks. Social engineering tactics like phishing can trick users into revealing sensitive information like private keys or login credentials. Users should be vigilant against phishing attempts, use secure communication channels, and verify the authenticity of messages and websites. 21. Governance risks. Decentralized autonomous organizations, DAOs, and governance tokens introduce a form of decentralized decision-making. However, governance mechanisms may be susceptible to manipulation, collusion, or centralization. Users participating in governance should be aware of potential risks and actively engage in community discussions to ensure the integrity of decision-making processes. 22. Custodial risks. Users who entrust their cryptocurrencies to custodial services, such as centralized exchanges or wallet providers, face risks related to the security and solvency of those services. Cold storage solutions, hardware wallets, and self-custody options can reduce reliance on custodial services and enhance security. 23. Stablecoin risks. Stablecoins, while pegged to traditional fiat currencies, face risks related to maintaining their peg, regulatory scrutiny, and the management of reserve funds. Users should be aware of the mechanisms used to maintain stability in stablecoins and consider issues transparency and regulatory compliance. 24. Network congestion and scalability. Some blockchain networks may face scalability challenges, leading to congestion, slower transaction processing times, and higher fees during periods of high demand. Users should be prepared for potential delays and increased transaction costs during periods of network congestion. Projects addressing scalability concerns may gain importance. 25. Market manipulation. Cryptocurrency markets may be susceptible to manipulation, including pump and dump schemes, wash trading, and coordinated efforts to influence prices. Traders and investors should be cautious of market manipulation tactics and be aware of potential risks associated with low liquidity or thinly traded assets. 26. Cross-border legal risks. Cryptocurrencies operate globally, and legal frameworks vary across jurisdictions. Users may face legal compliance, tax implications, and cross-border enforcement challenges. Users should understand and comply with the legal requirements in their respective jurisdictions. Regulatory developments can impact the global landscape. 27. Dependency on developers. Cryptocurrency projects often rely on developer teams for ongoing maintenance, updates, and improvements. A lack of active development or disagreements within the development community can impact the project. Users should assess the commitment and expertise of development teams and the level of community engagement in open source projects. 28. Integration and interoperability risks. Interoperability between different blockchains and integration with existing systems can be challenging. Technical hurdles may hinder the seamless interaction of various blockchain projects. Users and businesses should consider blockchain projects' interoperability features and integration capabilities, especially in complex ecosystems. 29. Centralization risks in mining, proof of work, POW. Cryptocurrencies may face centralization risks if a few entities control a significant portion of the network's mining power. Centralization in mining can lead to a concentration of influence and potential security vulnerabilities. Users should be aware of mining distribution and network security. 30. Unexpected regulatory developments. Cryptocurrency markets are influenced by regulatory decisions, and unexpected regulation changes can impact digital assets' legal status and acceptance. Users should stay informed about regulatory developments globally and be prepared to adapt their strategies in response to changes in the legal landscape. The cryptocurrency ecosystem is dynamic and evolving, presenting both opportunities and risks. Users, investors, and businesses should conduct thorough research, exercise due diligence, and stay informed to navigate the complexities and mitigate potential cryptocurrency risks. Understanding and acknowledging these risks is essential for individuals considering involvement in the cryptocurrency space. Implementing sound risk management practices, staying informed about the latest developments, and exercising due diligence before making investment decisions are crucial steps for navigating cryptocurrency's dynamic and evolving landscape. Cryptocurrency risk management. Crypto risk management is the foundation for successful trading strategies in the volatile crypto markets. Cryptocurrency risk management identifies, analyzes, and mitigates the potential risks of using and investing in cryptocurrencies. Traders employ a systematic approach to identify, evaluate, and mitigate the crypto market risks associated with their investment decisions. It is a fundamental risk management concept in crypto trading that aims to preserve capital and enhance profitability. The volatile and sometimes unpredictable nature of crypto markets makes a robust risk management strategy essential for anyone involved with cryptocurrency. The cryptocurrency market is known for its unique characteristics, such as high volatility, technological complexities, regulatory uncertainties, and security challenges. Managing these risks is essential for individuals, investors, traders, and businesses involved in cryptocurrency. Hence, cryptocurrency risk management requires a systematic approach to identify, analyze, assess, and develop treatment plans for the risks associated with investing in digital assets. Investing in cryptocurrencies involves inherent risks that necessitate careful identification and management by financial institutions. A structured risk management process must be followed to navigate these risks effectively. Cryptocurrency risk management process. Cryptocurrency risk management identifies, analyzes, and mitigates the potential risks of using and investing in cryptocurrencies. The volatile and sometimes unpredictable nature of crypto markets makes a robust risk management strategy essential for anyone involved with cryptocurrency. The cryptocurrency risk management process consists of 5 stages: identification, analysis, assessment, treatment, and monitoring and review. Let us discuss the cryptocurrency risk management process. Step 1. Risk identification. The initial stage of cryptocurrency risk management entails identifying the risks associated with investing in cryptocurrencies. This necessitates conducting a comprehensive review of potential risks, encompassing market volatility, liquidity risk, cybersecurity risk, regulatory risk, and operational risk. Financial institutions can leverage various tools, including risk checklists, risk registers, and risk workshops, to thoroughly identify risks, leaving no stone unturned. To ensure a thorough risk identification, a systematic approach is imperative, involving a meticulous analysis of factors that can impact the value of cryptocurrencies. Several vital factors must be considered during the risk identification process. 1. Market volatility. Cryptocurrencies are notorious for their high volatility, with prices capable of fluctuating dramatically within a short period. Investors must factor in the potential impact of market volatility on their portfolio's value. In May 2021, Bitcoin's value plummeted by almost 50% in weeks due to a combination of factors, including regulatory concerns in China and negative tweets from Tesla CEO Elon Musk. 2. Liquidity risk. Cryptocurrencies often need more liquidity, resulting in insufficient buyers or sellers to facilitate smooth transactions. This scarcity can lead to significant price fluctuations, potentially affecting an investor's portfolio value. For instance, in December 2020, Ripple's XRP token witnessed a staggering 40% decline in a single day following a lawsuit filed by the U.S. Securities and Exchange Commission, SEC, raising concerns about the token's classification as a security. 3. Cybersecurity risk. Cryptocurrencies are highly vulnerable to cyber attacks, necessitating a thorough evaluation of the potential impact of security breaches on portfolio value. An illustrative example is the January 2018 security breach suffered by the Japanese cryptocurrency exchange CoinCheck, resulting in the loss of over $500 million worth of NEM tokens and a subsequent 10% drop in the token's value. 4. Regulatory risk. The regulatory landscape surrounding cryptocurrencies constantly evolves, and investors must stay informed about regulatory changes that can impact their portfolio value. For instance, in September 2017, China's announcement of a ban on initial coin offerings, ICOs, and cryptocurrency exchanges led to a nearly 30% decline in Bitcoin's value. 5. Operational risk. Cryptocurrency exchanges and service providers face various operational risks, including system failures, human error, and fraud. Investors need to evaluate the potential impact of such risks on their portfolio value. An illustrative case is the January 2019 security breach suffered by Cryptopia, a New Zealand-based cryptocurrency exchange, resulting in the loss of over $16 million worth of cryptocurrency. 6. Geographical and delivery channel risks. Geographical risk is expected in assessing financial crime risks. It relates to the customer's location. Understanding how and where the crypto asset was invented is essential in dealing with cryptocurrencies other than Bitcoin and Ethereum. This knowledge is crucial when establishing relationships with crypto exchanges or onboarding new customers, especially for banks and over-the-counter traders. Additionally, delivery channel risk must be understood. Whether a company operates solely online, a cryptocurrency-exposed bank or a provider of crypto ATMs, each delivery channel poses distinct risks that require careful consideration. Financial institutions can leverage various tools such as risk checklists, risk registers, and risk workshops to identify these and other potential risks effectively. These tools ensure comprehensive risk identification, leaving no room for oversight. For instance, a risk register is a document that meticulously records all identified risks, their probability of occurrence, their potential impact on the organization, and the corresponding action plan to mitigate each risk. This document is a vital reference point for organizations' risk management efforts. Furthermore, a risk workshop facilitated by an external consultant or an internal risk manager fosters a collaborative environment where stakeholders from diverse areas come together to brainstorm and identify potential risks. The aim is to comprehensively identify as many potential risks as possible and analyze them in detail. Risk identification stands as the foundational pillar of cryptocurrency risk management. By adopting a systematic approach and considering critical factors such as market volatility, liquidity risk, cybersecurity risk, regulatory risk, and operational risk. Investors can proactively identify and mitigate potential risks associated with investing in cryptocurrencies. Step 2. Risk analysis of cryptocurrency risks. Once risks have been identified, the subsequent step involves analyzing each risk in detail. This analysis assesses the likelihood of the risk materializing and its potential impact on the financial institution's portfolio. Quantitative and qualitative techniques, such as scenario analysis, stress testing, and sensitivity analysis, can be employed to perform risk analysis. These techniques aid in identifying the potential impact of different risk scenarios and evaluating the effectiveness of various risk mitigation strategies. In the realm of cryptocurrency investments, risk analysis stands as the pivotal second step towards effective risk management. This crucial phase entails thoroughly examining and evaluating identified risks to ascertain their potential impact on organizations and the likelihood of their occurrence. The overarching objective of this step is to prioritize the identified risks and devise suitable strategies for mitigating them. Key factors for comprehensive risk analysis. To conduct a comprehensive risk analysis, financial institutions must take into account several critical factors. 1. Likelihood of occurrence. Determining the likelihood of a risk materializing involves assessing the probability of its occurrence in the future. This assessment can be conducted by analyzing historical data, current market trends, and expert opinions. A holistic approach to evaluating risk probabilities is essential for informed decision-making. 2. Impact on the organization. The impact of risk on an organization refers to the potential consequences it may entail if it were to transpire. Such consequences could encompass financial losses, reputational damage, or legal and regulatory penalties. A thorough understanding of the potential impact enables organizations to prepare and implement suitable risk mitigation measures. 3. Interdependencies. The interconnected nature of risks necessitates considering the potential for one risk to trigger or exacerbate another. Evaluating these interdependencies is crucial when developing risk mitigation strategies. A comprehensive approach should encompass identifying and assessing such linkages between risks. 4. Risk tolerance. Risk tolerance denotes the level of risk that an organization is willing to accept. This factor varies depending on an organization's goals, financial resources, and regulatory requirements. Understanding risk tolerance is vital for aligning risk management strategies with an organization's overall risk appetite. Based on a comprehensive analysis of the identified risks, financial institutions can prioritize them and formulate appropriate risk mitigation strategies. For instance, diversifying the portfolio of cryptocurrencies can help mitigate the impact of market volatility. Implementing robust cybersecurity measures can reduce the likelihood of security breaches. Each risk requires a tailored approach to mitigation. Risk analysis assumes a critical role in the realm of cryptocurrency risk management. By meticulously analyzing and evaluating identified risks, financial institutions can prioritize them and develop appropriate risk mitigation strategies. Using historical data, current trends, and expert opinions ensures that the risk analysis is comprehensive and accurate and protects investments from potential losses. Step 3. Performing cryptocurrency risk assessment. Following risk identification and analysis, the next phase involves a risk assessment. This entails assigning a risk score to each identified risk based on its likelihood of occurrence and potential impact on the financial institution's portfolio. Financial institutions can employ a range of risk rating scales, such as the likelihood impact matrix or the risk heat map, to conduct risk assessments. These tools aid in prioritizing risks and identifying those that require immediate attention due to their significance. Risk assessment is a crucial process that allows organizations to proactively identify and mitigate potential vulnerabilities, allocate resources effectively, and safeguard against cryptocurrency financial crime risks. Cryptocurrencies have witnessed successful efforts to curb their utilization for financial crime. It is crucial to have robust systems, controls, and procedures to ensure that a company does not inadvertently facilitate illicit activities. This is where cryptocurrency risk assessment becomes paramount. Crypto traders must comprehend potential impacts and take preventive measures by conducting a risk assessment tailored to their business. Types of risk assessments. Risk assessments are performed periodically at different levels, including annual, ad hoc, or continuous monitoring of customers. Here are 3 common risk assessment types. 1. Enterprise risk assessments, conducted annually. These assessments identify major risk categories such as system risks, cybersecurity risks, operational risks, fraud risks, HR risks, market risks, financial risks, and regulatory risks. Each category is further broken down to determine the specific exposure. 2. Financial crime risk assessments. These annual assessments focus on money laundering risks. They scrutinize customer geography, customer types, offered products, and distribution channels. 3. Customer risk assessments. This assessment calculates customer risk scores using various criteria such as geography, customer type, customer activity, and blockchain or cryptocurrency transaction history. Benefits of risk assessments. Cryptocurrency risk assessments offer several benefits in developing and enhancing anti-financial crime frameworks in the cryptocurrency sphere. 1. Mapping vulnerabilities. Risk assessments proactively identify potential vulnerabilities, helps in addressing them before regulatory, civil, or criminal scrutiny arises. Understanding how criminals might exploit specific products or services is vital. 2. Resource planning. Once vulnerabilities are identified, it is easy to determine the controls needed to mitigate them. This risk-based approach allows you to devise effective strategies and allocate scarce resources appropriately. Questions like which external tools are worth investing in? And what skills do our AML analysts need? Help optimize resource allocation. 3. Development strategy. Growth and innovation are constant endeavors in the fast-paced cryptocurrencies sector. Risk assessments guide decision-making, such as determining which new coins to list on exchanges. Leveraging risk assessment insights aids organizational development efforts. 4. Evolving dialogue. Risk assessments should facilitate ongoing dialogue, reflecting insights and feedback from senior management, auditors, consultants, and stakeholders. Regular updates, ideally annually, ensure relevance and accommodate evolving perspectives. Key components of cryptocurrency financial crime risk assessment. A comprehensive cryptocurrency risk assessment should cover 5 key risk areas: customers, products, transactions, geographies, and delivery channels. 1. Customer risk. Understand customer risk by examining transaction types and volumes. Risk profiles can be evaluated at individual and cluster levels, with clusters referring to customer group addresses. 2. Product risk. Evaluate risks associated with specific crypto assets, considering factors such as storing private keys or facilitating transfers. 3. Transaction risk. Analyze blockchain data to establish transaction risks. While information for cryptocurrencies like Bitcoin is readily available, others like Monero need help obtaining transaction details. 4. Geographical risk. Consider the geographic factors related to customer location or the base of operations for specific cryptocurrencies or exchanges. 5. Delivery channel risk. Understand the risks associated with various delivery channels, including online platforms, banks with cryptocurrency exposure, or crypto ATM providers. A risk assessment should be specific to a business and presented in a suitable format to ensure effectiveness. For instance, using an Excel spreadsheet to document risk calculations and highlight areas of high risk simplifies tracking and facilitates regulatory compliance. Key elements of risk assessments. Having identified the key risk areas and determined where to focus your efforts, certain elements should be considered during the risk assessment process. 1. Specificity. Risks discussed in the assessment should be specific to the business, aligning with your anti-financial crime framework. Tailoring the assessment to an organization ensures relevance and effectiveness. 2. Format. The risk assessment should be presented logically and sensibly. Use Excel spreadsheets to document risk calculations and highlight areas of significant concern. This approach aids in tracking and helps regulators comprehend the assessment. 3. Scenario analysis. Assess financial crime risks across multiple scenarios by evaluating the likelihood of risks and their potential impact on a business. This analysis enables a comprehensive understanding of the threats posed and helps prioritize mitigation efforts. 4. Controls assessment. It is crucial to address the controls in place to mitigate risks and assess their effectiveness. Merely stating that systems and controls exist is insufficient if they do not effectively reduce the identified risks. Evaluating controls allows for a more accurate assessment of residual risk. An example of cryptocurrency risk assessment. During a risk assessment, consider a scenario where a customer falls victim to a scam and uses cryptocurrencies for scam-related payments. Given the prevalence of crypto scams, the likelihood of this scenario is relatively high. The impact can be considered moderate. Next, calculate the inherent risk of this scenario. Suppose it is determined to be medium risk. An organization must know these risks and have systems and controls to prevent such incidents. Controls could involve capturing client information, monitoring or blocking deposits to high-risk wallets, and implementing transaction monitoring rules and limits. These measures can significantly mitigate the risk. Considering these controls, the inherent risk may be reduced to a low or medium residual risk, depending on the specific risk model employed. Step 4. Developing a treatment plan for cryptocurrency risks. The final step in the cryptocurrency risk management process entails developing a treatment plan for the identified risks. This involves formulating a comprehensive risk mitigation strategy designed to minimize the likelihood and impact of each risk. Financial institutions can use various risk mitigation techniques to craft an effective treatment plan, including risk avoidance, reduction, transfer, and acceptance. These techniques help ensure appropriate portfolio diversification and effectively manage risks associated with cryptocurrency investments. The Risks Treatment Plan is a comprehensive framework designed to identify and mitigate potential risks in the cryptocurrency and NFT landscape, ensuring a secure and compliant environment. Risk assessment is a crucial step in cryptocurrency risk management, and developing a treatment plan is the final stage of this process. The treatment plan involves identifying appropriate risk mitigation strategies to reduce risk exposure to an acceptable level based on the financial institution's risk appetite. This includes considering risk mitigation strategies, risk transfer strategies, and risk acceptance strategies. For cryptocurrency risks, risk mitigation strategies include diversifying the portfolio, implementing robust cybersecurity measures, and conducting thorough due diligence on service providers and exchanges. Risk transfer strategies can involve purchasing insurance policies to cover losses due to cyber attacks or fraud. Risk acceptance strategies are employed when the risk exposure is manageable and within the institution's risk appetite. Cryptocurrency Risks Treatment Plan. To illustrate the implementation of a treatment plan, consider the example of a financial institution addressing cryptocurrency risks identified in the risk assessment. 1. Market volatility. The institution may diversify its portfolio and implement stop-loss orders and sell-offs to minimize potential losses. 2. Liquidity risk. The institution may establish relationships with multiple service providers and exchanges, utilize limit orders or trade execution algorithms, and manage exposure to sudden market fluctuations. 3. Cybersecurity risk. Robust cybersecurity measures like two-factor authentication, encryption, and regular security audits are implemented. Thorough due diligence is conducted on service providers and exchanges to ensure adequate security measures. 4. Regulatory risk. The institution closely monitors regulatory developments, adjusts its investment strategy accordingly, and engages with regulators and industry groups to advocate for clear regulations. 5. Operational risk. Robust internal controls, risk management processes, regular audits, and risk assessments are implemented to mitigate operational failures. Financial institutions can effectively reduce risk exposure and make informed investment decisions by implementing appropriate risk mitigation strategies based on the treatment plan. Addressing economic crimes like money laundering, which have become increasingly borderless and sophisticated in the digital age, is essential. The convergence of fraud risk and money laundering, such as identity theft, highlights the need for comprehensive measures to combat illicit activities in the cryptocurrency sphere. To effectively address the money laundering risks associated with cryptocurrencies and NFTs, developing a robust anti-money laundering (AML) framework is essential. This framework consists of several key components. Money laundering risk management is vital to the overall enterprise-wide risk management framework. It begins with defining the organization's risk appetite, which informs the risk management policy and tolerance. Since the fintech landscape is diverse, there is no one-size-fits-all approach. Therefore, conducting a thorough risk assessment based on external and internal factors is crucial. This ongoing process helps identify existing risks and determines appropriate mitigation strategies. Implementing the AML policy involves establishing a solid risk governance and control environment. This includes the formation of the board of directors, audit committee, executive committee, and the 3 lines of defense. 1. The first line of defense consists of business operations responsible for day-to-day risk management activities. 2. The second line of the defense comprises finance, risk, and compliance functions that provide oversight, set directions, define policies, and ensure compliance. The compliance officer is critical in reviewing and implementing the AML program, requiring appropriate training and access to necessary resources. 3. The third line of defense is internal audit, which offers independent challenge and assurance on the effectiveness of systems and controls. Audit findings contribute to continuous improvement of the compliance risk management process. The customer life cycle encompasses customer selection, acceptance, and exit, and it can be broken down into the following parts. 1. Understanding risk. Establishing a risk rating methodology considering customer types, geographic locations, business segments, products/services, and delivery channels. Leveraging technology and big data, risk algorithms can be used to access and include additional information in risk assessments. 2. Customer due diligence, CDD, applying processes and controls that utilize risk assessment results to make informed decisions regarding accepting or rejecting a business relationship with a specific customer. In the case of fintechs, non-face-to-face CDD is often employed, utilizing identification/verification technology to prevent fraudulent risks during onboarding. 3. Ongoing review and monitoring, regularly reviewing and monitoring existing businesses or clients through periodic due diligence, transaction monitoring, and red alert systems. Using digital solutions and leveraging artificial intelligence, AI, with machine learning and natural language processing capabilities can enhance the identification of money laundering and terrorist financing risks, enabling more effective response and monitoring of suspicious activities. 4. Reporting and escalation procedures, monitoring trends, establishing key performance indicators, KPIs, and generating statistics for internal stakeholders. External reporting involves sharing information with investors, external auditors, regulators, and authorities, including suspicious activity and transaction reporting. Escalation refers to promptly escalating breaches and incidents upon identification. 5. Customer risk assessment before onboarding. During the initial risk assessment phase, Prospective customers may only be accepted if they fall within the company's risk appetite. Conditions may change after establishing business relationships, necessitating decisions to terminate relationships due to changes in business, regulatory environment, customer activities, or alerts triggered by transaction monitoring. Governance is critical in this process, as reputational and regulatory impacts on the firm can be significant. Policies and procedures for customer exits must be established. Step 5: Monitoring and Review. The monitoring and review aspects of a cryptocurrency risk management process are crucial for maintaining the effectiveness of risk mitigation strategies over time. This stage involves continuous surveillance, periodic assessments, and adjustments based on the evolving cryptocurrency landscape. Here are the components of the monitoring and review. 1. Continuous surveillance. Market monitoring. Regularly track cryptocurrency markets for price movements, trends, and overall volatility. Utilize technical analysis, market indicators, and news updates to stay informed. Regulatory developments. Keep abreast of changes in cryptocurrency regulations globally. Regularly check for updates and announcements from regulatory authorities to ensure compliance and adjust strategies accordingly. Technology updates. Stay informed about advancements and potential vulnerabilities in blockchain technology, smart contracts, and the underlying protocols of cryptocurrencies. 2. Portfolio review. Periodic assessments. Conduct regular reviews of the cryptocurrency portfolio to assess its performance and alignment with investment goals. This includes evaluating individual asset performance, diversification strategies, and overall portfolio balance. Risk exposure analysis. Reassess the portfolio's risk exposure to market conditions. Consider factors such as changes in the economic environment, global events, and technological developments that may impact the risk profile. Rebalancing. Adjust the portfolio as needed based on the assessment findings. This may involve rebalancing asset allocations, reallocating funds to reduce risk exposure, or capitalizing on emerging opportunities. 3. Risk tolerance adjustment. Review financial goals. Periodically reassess financial goals and objectives. Changes in personal circumstances, investment horizon, or risk appetite may necessitate adjustments to the risk management strategy. Communication with stakeholders. If managing cryptocurrency funds on behalf of others, communicate any changes in risk tolerance or strategy to stakeholders. Transparency is vital to maintaining trust and managing expectations. 4. Adaptability and flexibility. Learn from experience, analyze past experiences, including successes and failures, to identify lessons learned. Use this feedback to enhance the risk management process and adapt strategies for future decision-making. Adjust to changing conditions. Be prepared to adjust risk management strategies based on the dynamic nature of the cryptocurrency market. This includes incorporating feedback, integrating new risk management tools, and refining approaches to stay effective in changing conditions. 5. Feedback loop. Continuous improvement. Establish a feedback loop within the risk management process. Encourage open communication among team members or stakeholders to share insights, address challenges, and propose improvements. Document and analyze incidents. Document any incidents or unexpected events that occur. Analyze these incidents to understand their impact on the portfolio and the effectiveness of risk mitigation measures. Use this analysis to refine risk management strategies. 6. Education and awareness. Stay informed, continuously educate oneself and the team about emerging risks, market trends, and advancements in the cryptocurrency space. Stay proactive in seeking knowledge to adapt to new challenges effectively. Training programs. Conduct training programs or workshops to ensure team members are well versed in the latest risk management practices and technologies. By integrating robust monitoring and review processes into the cryptocurrency risk management framework, individuals and entities can enhance their ability to adapt to market dynamics, regulatory changes, and technological developments. This continuous improvement cycle is essential for maintaining a resilient and effective risk management strategy in the ever-evolving world of cryptocurrencies. Critical components and strategies of cryptocurrency risk management. Measuring risks is the first step in effective crypto risk management. To do this successfully, traders must consider various factors and employ multiple tools and methods. Understanding the crypto market risks associated with a particular trade is paramount. Here are critical components and strategies involved in cryptocurrency risk management. 1. Price volatility. Cryptos are known for their price swings. Measuring historical volatility helps traders assess the potential risks associated with a particular crypto asset. The wider the price fluctuations, the higher the risk. It is essential to establish clear investment or trading strategies to manage exposure to price fluctuations, including setting profit targets and stop-loss levels. Likewise, spreading investments across different cryptocurrencies can help mitigate the impact of extreme price movements in any asset. 2. Security risks. It is essential to use secure wallets, such as hardware wallets or reputable software wallets, to protect private keys from potential hacks or unauthorized access. Conducting regular security audits of wallets, exchanges, and any other cryptocurrency platform is also good. 3. Exchange risks. Exchange selection using reputable and well-established cryptocurrency exchanges with a track record of security and reliability. Diversifying across exchanges spreads assets across multiple exchanges to reduce the impact of any exchange failure or security breach. 4. Regulatory compliance. Regulatory environments for cryptocurrencies vary globally and can change rapidly. Staying informed about regulatory developments and ensuring compliance with local laws is crucial. Legal advice may be sought to navigate complex regulatory landscapes. Seeking legal advice to assure compliance with relevant regulations in the jurisdictions where one operates. Monitoring regulatory changes helps to stay informed about evolving regulatory environments and adapt strategies accordingly. 5. Operational risks. Best practices help to adhere to best practices for transaction execution, avoid common pitfalls, and stay updated on technological advancements. Regular updates ensure wallet software, trading platforms, and other tools are updated to address potential vulnerabilities. 6. Liquidity risks. Liquidity assessment helps evaluate the liquidity of chosen cryptocurrencies and markets to avoid difficulty in buying or selling assets at desired prices. Stress testing helps assess the impact of adverse market conditions on liquidity and portfolio value. 7. Market risk. Cryptocurrencies are known for their high price volatility. Traders and investors must know potential price fluctuations and set risk tolerance levels accordingly. Illiquid markets can result in slippage, challenging executing trades at desired prices. Managing position sizes and using liquid assets can help mitigate liquidity risk. 8. Operational risk. Cryptocurrency exchanges are susceptible to technical issues, outages, and hacks. Diversifying holdings across multiple reputable exchanges and using hardware wallets for long-term storage can minimize exchange-related risks. Technology risks raise problems such as wallet vulnerabilities, software bugs, or blockchain forks that can impact cryptocurrencies' security and functionality. Regularly updating software and employing best practices in wallet security are essential. 9. Security risk. Cryptocurrency holdings are vulnerable to cyber attacks, including phishing, hacking, and malware. Strong security measures, such as two-factor authentication, secure passwords, and cold storage solutions, help protect assets from unauthorized access. 10. Smart contract risks. For users engaging with decentralized finance, DeFi, platforms, understanding and assessing the risks associated with smart contracts, including vulnerabilities and code exploits, is essential. 11. Diversification. Spreading investments across different cryptocurrencies can help manage crypto risk. Spreading investments across different assets can reduce risk. A single adverse event would not impact the entire portfolio. If one asset performs poorly, others may compensate. Diversifying a cryptocurrency portfolio across different assets can help spread risk. Avoiding overconcentration in a single asset or market segment reduces the impact of adverse events on the overall portfolio. 12. Risk assessment and monitoring. Regularly assess and reassess risk exposure based on market conditions, new information, and changes in the regulatory environment. Monitoring portfolios and staying informed about industry developments can aid in timely risk management decisions. 13. Employing network/device security measures. A risk mitigation technique is getting antivirus clients like Avira and Kaspersky to provide an extra layer of security on devices and networks. These provide comprehensive protection from malware infections, spyware, and data theft to protect online payments using bank-grade encryption. 14. Know how to store digital currency. This is essential to ensuring one takes the necessary steps to safeguard their cryptocurrency portfolio, which is safely stored using an exchange or in a digital wallet. While there are different kinds of wallets, each has its benefits, technical requirements, and security. As with exchanges, a trader should investigate its storage choices before investing. 15. Diversify investments. As with any investment portfolio, diversification is a key risk management strategy underpinning any sound investment approach. The proverbial "don't put all your money in one basket" holds for bitcoins as it does for the proverbial basket. Because a particular crypto and exchange is the most popular, it doesn't make it the only one to be utilized. There are thousands of options, and spreading investment across several currencies is better. This can also include pursuing alternative investments to hedge against volatility in the crypto market and serve as a risk transfer strategy. 16. Invest what you can afford to lose. This age-long strategy needs to be addressed. The volatility in the market means that even one's capital may eventually be at risk of loss, so funds that the loss will become a catastrophic issue should not be deployed into a highly speculative instrument like crypto. 17. Stop-loss order. The stop-loss order helps specify an exit point in the market. It limits losses when a trade goes against your prediction. A trader will have losses at some point and can do nothing about it. Losses can be controlled using a stop-loss order every time you trade. 18. Have a backup strategy. Consider what happens if a computer or mobile device, whichever means of storing a wallet, is lost, stolen or inaccessible. This is necessary to retrieve the cryptocurrency through a backup strategy. 19. Initiate two-factor transaction authentication. Initiating two-factor authentication for crypto transactions to ensure all transactions on one's wallet require a two-factor authentication process like a combination of username/password with OTP or an authentication code to the email or phone number will add an extra layer of security to the infrastructure, which can go a long way in preventing malicious attacks. This is a clear risk mitigation strategy that aims to limit the possibility of the risk crystallizing and the severity of the impact of a compromised wallet password by depending on a second-factor authentication. 20. Risk mitigation strategies. Utilize risk management tools such as stop-loss orders to limit potential losses. Set clear investment goals, time horizons, and risk tolerance levels. 21. Develop a trading strategy. A common pitfall crypto traders make is to try and wing it, relying on gut feeling or instinct to initiate and execute trades. While this can often be very effective, it can only be sustained with a proper trading plan/strategy. Adequate planning helps manage risk and get consistent results. A good plan should detail when to open and close trades, how much risk a trader should take per trade and the risk-to-reward ratio. 22. Fundamental analysis, evaluating the fundamentals of crypto can reveal potential risks. Factors like the project's team, technology, and adoption rate can affect a coin's stability. 23. Technical analysis, historical price data, patterns, and indicators can provide insights into a trade's potential risks and rewards. 24. Market sentiment, monitoring market sentiment through social media, news, and forums can help gauge the community's perception and potential risks. 25. Quantitative metrics, various metrics like the Sharpe ratio can quantitatively measure risk and reward for a particular crypto asset. 26. Stop-loss orders, these automated orders protect against excessive losses. Set a price level you're willing to sell, preventing further decline. Placing stop-loss orders is crucial to crypto trading risk management. They automatically sell an asset if it reaches a predetermined price, limiting potential losses. 27. Research exchanges. One essential risk management strategy is acquiring in-depth information and knowledge about cryptocurrency exchanges before investing. Do your research, read reviews, and talk with more experienced investors before moving forward. Also, keep abreast of the planned regulatory rollout of transaction frameworks and guidelines to enable proactive planning and response to emerging risks. 28. Continuous learning, stay informed about market sentiment, news, and events that may impact cryptocurrency. It is good to be well informed about developments in the cryptocurrency space, including technological advancements, regulatory changes, and market trends. Understanding the risks associated with different aspects of cryptocurrency, including smart contract vulnerabilities, network upgrades, and protocol changes, is essential. 30. Measurement and capping of trading positions. Another excellent risk management strategy is determining the maximum cap of each single trade relative to the total investment portfolio. This ensures that the risk taken per trade is adequately rationalized and the rationale is consistently applied. The entire or an overly significant portion of a crypto portfolio should not be risked on a trade. 31. Emergency preparedness. Contingency planning, developing contingency plans for various scenarios, such as sudden market crashes, exchange outages, or regulatory crackdowns. 32. Emergency response, knowing how to respond swiftly and effectively to unexpected events, including having access to alternative trading platforms or secure backup options. Measuring risks is an ongoing process in crypto trading risk management. Traders must continuously adapt to changing market conditions, making informed decisions to optimize their risk-reward ratios. Challenges in cryptocurrency risk management. Here are some challenges in cryptocurrency risk management. 1. Diversity. The first challenge risk managers need to address is that cryptocurrencies are qualitatively diverse and not interchangeable. The bewildering array of cryptocurrencies differs across multiple dimensions, particularly concerning security, programmability, and governance characteristics. There is no cheapest to deliver cryptocurrency. So, when measuring, managing and monitoring risks, one must consider the differences in features across cryptocurrencies. The original Bitcoin, BTC, cryptocurrency is a relatively simple construct. It is designed to send, receive and store value in a virtual and cryptographic format, with functions replicating that of money and gold. The second most widely traded cryptocurrency, Ethereum, ETH, extends the core functionality of BTC by adding on more complex, self-executing smart contract capabilities that can be used to replicate complex financial instruments, transactions and performance contracts digitally. ETH, moreover, has even been used to create exchanges. Adding to the complexity are cryptocurrencies like stablecoins, whose value is tied to fiat currency, USD. These digital assets exchange fixed value by exchanging national currencies for non-stable cryptocurrencies. The landscape is further complicated by the specifics associated with the issuance and governance of cryptocurrencies. For example, transaction tracking and validation responsibilities are divided between cryptocurrency issuers and users. 2. Valuation difficulties. To manage the risk of any financial instrument, one of the first steps is to quantify and determine its exposure using customary market-wide methodologies. But cryptocurrencies are different. There is no consensus valuation approach, no commonly accepted metrics, and reported pricing information may differ substantively across venues. Risk managers need to appreciate the widespread use of complex and occasionally inconsistent valuation approaches to determine a reasonable value for a cryptocurrency. Some analysts tackle the valuation challenge from a functional perspective by treating cryptocurrencies as currency in circulation, or fiat money such as USD or EUR. However, this approach builds on a distorted assumption that suitably glosses over fundamental legal differences between cryptocurrencies and traditional financial instruments. Specifically, cryptocurrencies are not legal tender, do not benefit from legal safeguards or implicit or explicit government backing, and cannot be legitimately used to settle transactions with finality. The most popular technique to value cryptocurrencies is estimating each cryptocurrency's addressable market and the current market capitalization. However, this approach needs to capture the actual and potential value cryptocurrencies can create from how they are used. Consequently, some analysts take the process further by valuing cryptocurrencies from a network perspective, appraising the number of possible users and forecasting a series of probable scenarios for usage based on programmability structure or governance features. Since this valuation approach is both model and assumption driven, it may not stand up to high levels of scrutiny, but it does offer an additional level of understanding of the potential exposure and risk levels of cryptocurrencies. Other analysts, particularly on the institutional side, value these digital assets by the cost of electricity consumption needed to create, store and verify each cryptocurrency. While these valuation outcomes introduce some comparable standardization and consider underlying and defining features of the individual cryptocurrencies, they can be skewed by widely differing electricity costs across major mining centers. 3. Regulatory and legal dilemmas. Unlike financial instruments, cryptocurrencies are not regulated products and do not benefit from the standard legal protection of traded financial instruments. This leads to convoluted legal risks and inserts uncertainty, meaningfully influencing instability and risk management for these digital assets. An international consensus still needs to be on best regulating cryptocurrencies, particularly concerning policing product development and trading. Government stances have been inconsistent and, sometimes, downright erratic. Some countries have banned creating, selling, owning and trading in specific cryptocurrencies but concurrently allow and incentivize the proliferation of others. Other countries are developing forward-looking and wide-ranging regulatory standards for issuance, trading, reporting and transparency. Since these standards typically apply only within one jurisdiction, governments inadvertently create islands with rudimentary legal protection in an ocean of unregulated cryptocurrencies. For many, this essential legal protection is an opportunity to test the potential of cryptocurrencies. For others, the lack of uniform regulation perpetuates the legal, compliance and regulatory challenges standing in the way of the evolution of these assets. Risk managers must know that transacting in different cryptocurrency markets can carry an array of unusually complex legal and compliance hazards. 4. Data and modeling obstacles. Risk managers who need to model future cryptocurrency exposures and risks may need the necessary data. Indeed, inadequate transaction data limits one's ability to model the factors that drive cryptocurrency risk and returns and to compute fundamental measurement metrics, like stress testing and value at risk, VAR, versus expected shortfall, S. Cryptocurrencies are highly volatile and are available to trade 24/7, all across the globe. The detailed but narrow data set of actual transaction prices that cryptocurrency markets provide must be revised for modeling purposes. Since we are far from a consensus on price, return, or an equilibrium generation function for cryptocurrencies, modeling and forecasting these digital assets is akin to a guessing game. That is why many risk managers turn to statistical tools, like spectral decomposition, to model their cryptocurrency exposures and to identify factors that can be integrated into pricing, risk and trading models. However, these modeled prices are not actual, and their usefulness, particularly for stress testing purposes, is debatable. 5. Illiquidity and trading costs. The cryptocurrency market is generally less liquid and more expensive than traditional markets. The supply of many cryptocurrencies is controlled, with new units released according to a preset timetable, and it should thus come as no surprise that the high volatility of cryptocurrency prices is liquidity-driven. Cryptocurrency markets will likely continue to struggle with limited liquidity and high volatility, making effective price discovery an ongoing challenge. Gapping, moreover, continues to be a problem in these markets, constraining the ability of investors to exit from their cryptocurrency positions. Complicating matters further is mounting evidence that certain exchanges routinely manipulate prices, trade against customers, and front-run large trades. Part of the issue is that there needs to be uniformity in the treatment of cryptocurrency trading. Some exchanges incorporate the inherent features of cryptocurrencies, while others offer bilateral trading, with some replicating the core features of electronic trading platforms. Therefore, risk managers must understand the mechanics of specific trading venues. 6. Custody, clearing and settlement problems. Besides further regulatory clarity, institutional interest in cryptocurrencies depends on continued developments in providing prime brokerage and institutional-grade custody solutions. Today, specialized financial institutions and fintechs offer highly bespoke solutions ranging from straightforward digital wallets to complex functionalities that satisfy institutional investors. Institutional custodial solutions for cryptocurrencies are both legally and technologically complicated. The public drives part of the complexity, and private key encryption systems can be used to track and verify transactions cryptographically. Since they are easily and publicly accessible, these cryptographic keys must be safeguarded. Custodial solutions, therefore, must include multi-layered security features that appropriately manage and control how custodial systems can access, use and verify these keys. When these security measures are inadequate, disastrous results can ensue. Indeed, several cyber theft episodes, such as the demise of Mt. Gox, were caused by poorly designed security features that allowed easy access to protected cryptographic keys. The situation is more complicated because there is no collective standard for clearing and settling cryptocurrency transactions, exposing traders to substantive counterparty credit risks. Cryptocurrency payments settle as soon as the system authenticates the transaction. Authentication can be immediate or with some limited delay. However, the final settlement for trading in cryptocurrency depends on the features of the cryptocurrency, the exchange where the transaction takes place and the specifics of the custodial solutions. Moreover, since cryptocurrencies are not considered legal tender and cannot be legally used to settle a trade involving cryptocurrencies, these digital assets have to be exchanged for legal tender for settlement purposes. The actual cost of exchanging cryptocurrencies for fiat money can materially impact how exposures should be valued and managed and what additional risks must be considered when quantifying cryptocurrency exposures. Here is a simple example: a transaction exchanging BTC with ETH has to be settled in USD, requiring the exchange of BTC to USD and then USD to ETH. Each leg of such a transaction carries a cost. How the precise mechanics play out and what the actual risks may be depends on the unique relationship between the different players. The asynchronous nature of settling cryptocurrency trades is a substantive problem, mainly because the mechanics and logistics differ widely across exchanges between users of the same digital wallets and custodial solutions. This further complicates the estimation of the underlying risk exposures and heightens the severity of counterparty credit risks. Corruption is a final consideration in this challenge category. Cryptocurrencies have been at the center of several money laundering schemes, partly because of fraudulent custodial solutions and partly because flawed design features in the custodial standards have been exploited. These types of criminal activities require constant vigilance. 7. Cryptocurrency derivatives are very risky. Cryptocurrency futures trading continues to gain traction among investors and traders. However, unlike derivatives on financial instruments or commodities, these cryptocurrency derivatives are generally used to increase exposure rather than to reduce risks. By design, cryptocurrency derivatives available to trade are often exchange the difference contracts, also known as contracts for differences. CFDs are cash-settled contracts between investors and brokers based on the value of the underlying, for example, cryptocurrency, asset. Investors typically use CFDs to make price bets about whether the underlying asset or security will rise or fall. Interestingly, the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC, prohibit U.S. residents from opening CFD accounts on domestic or foreign platforms. Generally speaking, though, dodgy market participants take advantage of the low awareness of the differences between various crypto derivatives, and may even promote fraudulent instruments and investments. Solutions to cryptocurrency risk. Based on our discussions so far, the solution to the risk encountered in cryptocurrency trading includes 1. Regulatory approval. The most material reduction of the inherent risk associated with cryptocurrency is that of regulatory approval, which looks ironic since cryptocurrency is a decentralized currency with no regulatory governance or framework. Some regulatory approval could improve and imply acceptance and credibility in the eyes of the cryptocurrency community. 2. Alliances and adoption by a major trusted global organization. As many institutions embrace new technology, what better differential is there than to support a leading-edge digital currency or at least provide support to its customers as an offering? To be the first to market and pioneer a suite of offerings encompassing cryptocurrency would enhance the company's reputation and lead to a culture predisposed to technological innovation. 3. Structural mitigants. Enhancement of the ecosystem could include more robust cryptocurrency exchanges. These organizations help interested individuals trade a traditional currency, for example USD, for cryptocurrencies such as Bitcoin. In the conventional sense, cryptocurrency exchanges operate as not only exchanges but can also act as broker-dealers and custodians. If these exchanges were to hold a certain amount of reserves to survive any significant downturn or crash, adopting the same principles as a clearinghouse would add an extra layer of protection in times of volatility and market uncertainty. 4. Mature ecosystem. The use of cryptocurrency has increased enormously, and so too has consumers' ability to harness the powers of technology. Mobile phones, especially in emerging markets, have increased knowledge, transferability, and know-how. Mobile payments have increased from the rise of internet banking, increased consumer usage of alternative payment methods like Amazon gift cards, Apple Pay, Google Wallet, and PayPal, and advances in mobile payments technology have paved the way in tandem with the acceptance of cryptocurrency. 5. Risk management framework. The importance of risk documentation must be balanced with all involved in the ecosystem, maintaining consensus around risk management guidelines, standards and procedures to which they can align themselves to good industry best practices. A standard risk management framework would cover policies, standards and procedures relating to cyber, fraud, operational credit, physical security assets, IT security and data, third-party vendors, and anti-money laundering, encompassed by a business continuity and disaster recovery program. The framework must be enterprise-wide, as all these risks are highly correlated. The risk framework must be supplemented by real-time information gathered and scenario planning to be practical and actionable. Given the vast reliance on technology changes and development, special mention and attention must be paid to software upgrades. More importantly, every participant in the ecosystem chain should be risk assessed as to the adequacy and efficacy of the implementation of its documentation to aid confidence and reduce risk. 6. Education, training and education can go a long way in mitigating the risks and improving confidence, which continues to diminish with all the horror stories on social media. A comprehensive education package with an insight into the latest security methods backed up by anti-malware, backups, cold storage, intense and frequent password protection, and regular software updates can help mitigate cyber and fraud risks and improve confidence. The role of risk management in improving crypto finance. Crypto finance has a decentralized approach by design, meaning it operates differently than traditional markets. However, as noted above, it is still exposed to risk, some of which is the same as conventional finance. The key is identifying, understanding, communicating, and managing all the risks in crypto transactions. The exact steps to that identification will vary, depending on which side of the transaction one is on. Risk identification and communication are essential for those originating crypto finance transactions for investors, lenders, borrowers, and others. Risk understanding and management are crucial for those engaging in the transactions offered to potential investors, borrowers and lenders. Traditional finance, while sometimes viewed as the antithesis of crypto, utilizes core principles and tools which the crypto industry can begin to institute to a higher degree to protect the market as a whole. Here are some ways risk management helps improve crypto finance. 1. Focus on substance over form. Many crypto transactions and products call themselves one thing, but when the lawyers and auditors look in, it is shown that the substance needs to be clarified or match the naming or description. In simple terms, experts should weigh in before the product goes to market. The form and substance should both match and be made crystal clear. Classifications that look beyond marketing to the underlying characteristics and components of the products are essential. 2. Enable and use liquidity analysis and audited financials. This principle is closely tied to a complete set of audited financial statements and their accompanying notes. With the potential implementation of regulation, those involved with the crypto community should aim to produce these traditional financial reports to stay ahead of the market. If institutional investors involved with crypto conducted thorough pre-investment analysis and required audited financials, this would require their crypto counterparties to comply with normalized best practices without waiting for regulators to step in. 3. Conduct ongoing performance monitoring of the transactions and the counterparty. The entity that made the investment or loan should be responsible for conducting its ongoing, substantive performance monitoring of the crypto product and counterparty, for example, financial trend, variance analysis, and smart contract audit, where relevant. As a routine matter, the contracts should provide for regular statements that mirror those of similar traditional transactions and for a legally enshrined right to inspect the books. Reliable, fair value assessments of the crypto held, pledged as collateral, or otherwise used will be crucial to this analysis. 4. Clarify collateral, custody, and segregation of assets. Collateral is a critical component of traditional financial arrangements, and applying its processes could be transformative for the maturation of the crypto finance ecosystem. That is, custody should be apparent, the pledged assets should not be commingled with corporate assets, and the security interest should be carefully documented and crafted to protect the lenders. 5. Enhance disclosure and terms and conditions. Controlling one's finances should not end at the point of transfer to a third-party platform, therefore, how crypto businesses handle customer assets should not be a trade secret. Providers will protect their customers and themselves by sufficiently disclosing risks and basic practices. As the crypto industry grows, so too should transparency through disclosures. Precise, predictable, accurate disclosures and terms of service are a must-have. Promoting mature and easy-to-understand terms and conditions with complete disclosures to ensure good understanding for customers. Conclusion. This video has discussed cryptocurrency risk and cryptocurrency risk management. It explained the management of cryptocurrency risks. Cryptocurrency risk management requires a proactive and adaptive approach, considering the rapidly changing nature of the market. By implementing these strategies, individuals and entities can enhance their ability to navigate the challenges and uncertainties inherent in the cryptocurrency ecosystem. Effective crypto risk management involves a comprehensive approach considering market dynamics, operational challenges, regulatory changes, and security concerns. By implementing sound risk management strategies, participants in the cryptocurrency ecosystem can better navigate the inherent uncertainties and potential pitfalls associated with this dynamic market. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love to hear from you. Please post your comments and questions in the comment section below. If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything's channel, and press the notification button to be notified when new videos are uploaded. Thank you.